Today is November 29th, 2025. The crypto world never stands still, and big moves can reshape the landscape overnight. CoinShares International, a leading European digital asset manager, just announced a major change. It's delisting two crypto-backed investment products from Germany's Xetra exchange. This isn't just a routine adjustment, it's a calculated step in a larger strategy. CoinShares is streamlining its product lineup, preparing for a bold new chapter. The two products being removed are the CoinShares Physical FTX token and the CoinShares Physical Crypto Basket. While this might seem minor, it signals a shift in the industry and CoinShares' ambitions. The company is positioning itself for global expansion, especially targeting the US market. The timing is crucial, as the digital asset industry is still recovering from shocks like the FTX collapse. Companies are now more cautious, learning from past mistakes. CoinShares is leading by example, removing products tied to failed projects and complex structures. This is about presenting a clean, robust portfolio to attract highly regulated US investors. The delisting is a public signal of CoinShares' American ambitions. It shows the company is willing to make tough decisions to adapt to a new era of crypto finance. CoinShares isn't just reacting, they're shaping their future. A US listing is the goal, shared by many international crypto firms. Achieving it requires meticulous preparation and a clear vision. The removal of these ETFs is a step toward that vision. It demonstrates seriousness and adaptability. CoinShares is setting the stage for a new phase in its corporate story. The crypto industry is watching closely as CoinShares makes its move. To grasp CoinShares' move, let's break down what an ETF is. An ETF, or exchange-traded fund, is like a basket holding various investments, stocks, bonds, or commodities. Instead of buying each asset separately, you buy a share of the ETF, giving you exposure to everything inside. ETFs trade on stock exchanges, just like regular stocks, making them easy to buy and sell throughout the day. Their prices fluctuate with the value of the assets they hold. This liquidity and accessibility have made ETFs popular worldwide. Unlike mutual funds, which price only once daily, ETFs can be traded anytime the market is open. They often have lower management fees, adding to their appeal. ETFs offer instant diversification and are cost-effective. They've democratized investing, making it accessible to more people. With a standard brokerage account, anyone can invest in ETFs. This flexibility and simplicity have fueled their explosive growth. In essence, ETFs bundle assets into a single tradable security. They spread out risk and are easy to manage. ETFs are now a cornerstone of modern portfolio management. They provide a straightforward path to building a diversified portfolio. For many, ETFs are the gateway to smarter, more efficient investing. Now let's see how ETFs work in the crypto world. A crypto ETF operates like a traditional ETF, but holds digital assets like Bitcoin or Ethereum. Buying and storing crypto directly can be daunting. Wallets, private keys, and security risks. A crypto ETF solves this by letting investors buy shares in a fund that owns the crypto, managed and secured by professionals. This offers exposure to crypto prices without the technical headaches. CoinShares specializes in spot, or physically backed crypto ETFs. Each share is backed by actual cryptocurrency held in custody. This model provides direct exposure to the asset's price. There are also futures-based ETFs, but spot ETFs are preferred for pure exposure. Crypto ETFs have opened the market to traditional investors, bringing new capital and legitimacy. Listing on major exchanges signals that crypto is a serious asset class. It makes investing in digital assets safer and more mainstream. Crypto ETFs are a regulated, user-friendly bridge to the digital asset market. They encourage wider adoption and integrate crypto into global finance. For many, they're the easiest way to enter the crypto world. CoinShares is delisting two products, the Physical FTX token, CFTT, and the Physical Crypto Basket, CBC1. The delisting takes effect in February 2026, giving investors time to adjust. The FTX token ETF gave exposure to FTT, the native token of the now-defunct FTX exchange. The Crypto Basket ETF offered diversified exposure to top digital assets, rebalancing periodically. Both products served a purpose when launched, providing regulated crypto access to European investors. But the market has changed. FTT's collapse and shifting demand for complex baskets made these products less relevant. CoinShares is pruning its lineup, focusing on its strongest offerings. This move reflects adaptation to new market realities. It's about preparing for future growth and a U.S. listing. The company is prioritizing products with clear demand and regulatory appeal. The fate of the CoinShares physical FTX token ETF is tied to the infamous FTX collapse. In 2022, FTX imploded amid fraud, wiping out the value of its FTT token. The ETF, based entirely on FTT, became worthless overnight. Trading was suspended to protect investors, leaving the ETF in limbo. Delisting it is necessary housekeeping, removing a failed product before entering the U.S. market. U.S. regulators would question any lingering ties to FTX. This move cleans up CoinShares' image and signals lessons learned. The FTX collapse exposed the risks of single-asset crypto ETFs. It's a reminder that concentrated bets on unproven tokens can end badly. CoinShares is now focusing on more resilient, established assets. Delisting CFTT is both a practical and symbolic step forward. Delisting these ETFs is part of CoinShares' bigger plan, breaking into the U.S. market. A U.S. stock exchange listing would give CoinShares access to vast pools of capital and millions of investors. But the U.S. regulatory bar is high. Every product must be compliant and transparent. CoinShares is working with U.S. advisors to meet these standards. Products tied to FTX or complex baskets are red flags for regulators. By removing them, CoinShares presents a clean, focused image. The company wants to be known for high-quality, physically backed Bitcoin and Ethereum ETFs. Streamlining isn't just about regulation, it's about telling a clear story to investors. A simple, robust product suite is more attractive than a cluttered lineup. CoinShares is sharpening its message and concentrating resources on the U.S. opportunity. The delisting is a short-term sacrifice for a long-term prize. It's about positioning for growth in the world's largest capital market. The U.S. market is the ultimate goal for any ambitious crypto firm. CoinShares is making sure it's ready. CoinShares' timing aligns with a seismic shift in U.S. crypto investing. The SEC's approval of spot Bitcoin ETFs in January 2024 was a game-changer. For years, the industry fought for this. Now, mainstream investors can access Bitcoin through regulated products. U.S. spot Bitcoin ETFs have attracted billions, proving massive demand. This success hasn't gone unnoticed by global players like CoinShares. The opportunity is huge, but the window to enter is closing as U.S. firms dominate. CoinShares has deep expertise in Europe and wants to compete in the U.S. A U.S. listing is the first step to launching its own ETF products for Americans. Streamlining its offerings is a direct response to this new reality. The U.S. is now the largest, fastest-growing market for crypto investment products. Every major crypto firm needs a U.S. strategy. CoinShares is executing its plan, making tough choices to compete. Delisting the two ETFs is a small sacrifice for a shot at the American market. The stakes have never been higher. For investors in the crypto basket ETF, the delisting means it's time to act. Sell shares before February 2026 to avoid complications. For the market, this move signals maturity and consolidation. The industry is shifting from experimental products to simple, transparent, physically backed ETFs. This trend will likely continue, with firms focusing on core products that meet regulatory standards. Fewer, higher-quality choices could make the space safer and easier for new investors. The focus on spot ETFs for major assets provides a clearer entry point. CoinShares' ambition highlights growing global competition in crypto. For investors, this means more innovation, lower fees, and better products as firms compete worldwide. CoinShares' delisting isn't just cleanup. It's a strategic move reflecting the future of digital asset investing. Shedding failed or complex products prepares the company for U.S. entry and signals a shift toward transparency and quality. The FTX collapse taught the industry hard lessons. Now, the focus is on resilience and trust. The success of U.S. spot Bitcoin ETFs has set a new standard. CoinShares is adapting, doubling down on its strengths to compete globally. For investors, the future means fewer exotic options, but greater security and clarity. Crypto investing is moving from a wild frontier to a mature, regulated market. CoinShares' strategy is a signpost on the road to a more professional, competitive crypto industry.